The loonie had a bad week. It dropped below 70 cents US for the first time since 2003, and one forecaster said it could even dip all the way to 59 cents US. Here to help explain the return of the low dollar and what it means for our economy and our pocketbooks, Craig Alexander. He's Vice President of Economic Analysis at the C.D. Howe Institute, and yes, you heard me right, because the last time you were here, welcome incidentally, last time you were here you were a TD guy, but you've just gone over to the C.D. Howe Institute, so we welcome you with your new appellation.
Thanks very much, Steve.
Nice to have you here. Let's put up this graphic if we can, please, Sheldon. This is the route that our dollar has taken over the past 4 or 5 years or so, and it is, you know, a few bumps and grinds along the way, but inexorably down, down, down. Craig, compared to other times in our history, how relatively quick or slow is that decline?
Well, as the chart shows, we've actually been seeing the Canadian dollar retreat since about 2012. So initially the decline was pretty orderly. I mean, it was just a sort of steady, slow grind lower. But what we really saw was it fall much more precipitously when oil prices tumbled last year and heading into this year, in conjunction with the financial market instability that we've been getting, a stock market correction around the world related to worries about China and the global economic outlook. So the appreciation certainly has gained momentum in recent months.
So it really is a petrocurrency, despite what everybody was saying.
Well, what's really fascinating about the Canadian dollar is it always is buffeted about by commodity prices because Canada is a major commodity exporting nation. And so a lot of Canadian exports, a lot of our terms of trade is related to commodities, and so there's always going to be that relationship. But the one thing that does seem to happen in financial markets is there are times when you get a really dramatic move in a commodity like oil, and the market just completely fixates on the relationship between energy and the Canadian dollar, and they completely forget about everything else. And so from a point of view of trading floors, foreign exchange traders will sit there and on the one hand they'll have the price of the current price of crude oil, and simultaneously they'll be hitting the sell button on the Canadian dollar every time they see oil drops. And so, you know, I think there's periods of time when the correlation between oil and the Canadian dollar gets stronger, and we certainly have been in that environment recently.
Craig, there are some people who are saying we got to do something about this. And I want to just focus on that we for a second. For example, is there much that the Prime Minister or the Finance Minister of this country can do to arrest this decline?
Well, I think generally people give the government too much power, or a sense of too much power in terms of determining the currency. When you look at global financial markets, the Canadian dollar is a flexible exchange rate. It floats the value floats in the marketplace. The value reflects the opinions of millions of investors. And from the point of view of the government, there's really limits as to what they could do. So, for example, Canadians don't like to see the drop in the Canadian dollar. So what could the Bank of Canada do about it? Well, they could raise interest rates. Well, would that be a good thing for the Canadian economy?
That's the Bank of Canada. I'm talking about the two politicians first off. We'll get to the bank in a second.
Okay, well, on the political side, there's very little control that the government has over the currency. Arguably the central bank would be the policy entity that would be able to have the greatest control. There are different exchange rate mechanisms. We have a floating exchange rate system. You could actually adopt a fixed exchange rate system where you peg the Canadian dollar to the US dollar. And what I find amazing is the last time we had a Canadian dollar that was below 70 cents, you had people talking about, should we peg the Canadian dollar to the US dollar? And you know what? That's precisely the wrong time to do it, because you'd lock in all of the decline in the value of the Canadian dollar. If you wanted to have a fixed exchange rate against the US, you would have done it when the Canadian dollar was at par, not when it's extraordinarily weak, sure, at below 70 cents.
But what I hear you saying is the most powerful politician in this country and the most powerful financial politician in this country can't do very much about this.
No, from the point of view of the federal government, if the upcoming budget has some additional stimulus in it, and that's going to add to economic growth in Canada, and financial markets believe that this is going to help the economy, well, then that will make the Canadian dollar look a little more attractive. But understand that in terms of the impact it would have on the currency, you're talking about maybe an impact of a couple of cents. You're not talking about being able to change the trajectory that the Canadian dollar is on.
Okay, Bank of Canada, you were about to say. The Bank of Canada itself, What can it do to arrest the decline?
So the Bank of Canada could opt to tighten monetary policy, raise interest rates that would make the Canadian dollar look more attractive. But of course, this would have a cost on the economy because at the end of the day, that would also mean higher borrowing costs for consumers, for businesses, and that would hurt economic prospects. So in actual fact, I think that would be a very poor response to the weakness in the Canadian dollar. And I think that's one of the reasons why just the other week we had a speech by Governor Polos where he emphasized the fact that the weakness in the Canadian dollar is reflecting lower energy prices, weaker economic growth, and it's part of what he characterized as the natural adjustment process. So in other words, the Canadian dollar is actually doing what it should be doing. It's actually helping the Canadian economy adjust to low commodity prices. And this is where the economic perception and the public perception really divide, because the general public hears, the stock market's down, the Canadian dollar's down, and it sounds negative. Well, the stock market down is negative. The Canadian dollar being down actually creates both winners and losers.
Let's go into that. Who wins when the dollar goes down?
So the big winners from the point of view of the Canadian economy is exporters, but ultimately what it translates to is better economic prospects, and for Canadians what that means is jobs. So in terms of the resource sector is suffering from the enormous drop in commodity prices, but oil is priced in US dollars. So the energy sector is selling barrels of oil in US dollars at, say $30 a barrel, or with the Canadian discount, even less than that. And then when they bring the money back into Canada, or when they translate to Canadian dollars, the weakness in the Canadian dollar softens the blow from the fall in oil prices. So were the Canadian dollar still at par, the pain in the energy sector would be greater. We'd see even a deeper economic contraction and recession in Alberta and Newfoundland, and weakness in Saskatchewan. So the Canadian dollar is helping those sectors to adjust. At the same time, it helps the non-resource exporters because it makes their products more competitive in our major trading market, which is the United States. And in the case of those, what you're likely to see is this is likely to be the sector that helps economic growth the most in the coming year. That's what we're really counting on to drive economic growth, because consumers have a lot of debt. We don't see consumer spending being the driver of economic growth. Business investment is going to be weak because the commodity sector isn't going to be investing in new capital projects. So if the domestic economy isn't going to drive growth going forward, what can? And the answer is exports. And so it's really critical to the Canadian economy that the U.S. is doing a bit better, and simultaneously Canadian exports in the U.S. has become much more attractive. And this is one of the reasons why I think in Canada you're going to see BC, Ontario, Quebec leading in terms of economic growth, because they're going to benefit from lower energy prices. They're also going to benefit from improved export competitiveness, and that will flow through to their economies. Weakness in the resource-rich economies, but understand things would be far worse if the Canadian dollar hadn't declined. So there is a very positive dimension to the weaker Canadian dollar, because it's actually providing a lot of stimulus.
But having said that, I wonder if you've got a business here in Canada and you want to trade, your products suddenly look a lot more attractive to the United States. But what if in an attempt to make those products, you have to buy goods from the United States in order to be competitive? Is it a wash at the end of the day?
So then now we're talking about those that are disadvantaged by the weaker Canadian dollar. And obviously it's bad news for importers. And for some exporters that use imported inputs in their production process, it means they won't benefit as much from the weaker Canadian dollar. At the same time, consumers don't do as well with a weaker Canadian dollar. To many Canadian households, it's going to feel like a pay cut, because what's going to end up happening is when they go to the grocery stores and they're looking at imported fruits and vegetables, prices are going to be a lot higher. In terms of imported meats, prices are going to be a lot higher. In terms of going to the malls, I think you're going to find that the discounts that you see on clothing and footwear are a lot less. So from a consumer point of view, they are going to benefit to some extent by the energy, the savings on things like gasoline. Although I'd stress that gasoline prices haven't dropped as much as crude oil prices, so Canadians aren't saving the full amount of the drop in oil prices in terms of gasoline. But at the same time, they're going to pay more for a lot of other consumer staples. And this is why a lot of Canadians are going to be unhappy about it. It's also going to be bad news if they're buying things on the internet and it's priced in US dollars. It's really bad news for snowbirds that are traveling abroad.
Let me pick up on that, because of course we are in the thick of the winter here. Do you have any research which suggests that the dollar, once it goes below whatever the number is, people actually cancel their vacations to the United States because they just don't want to pay, let's say, 40% more for those trips?
I don't have a piece of analysis, but anecdotally, it's absolutely true.
It does happen.
I think there's a point where, people look at it and they say, hey, it's now getting more expensive. And then you get to a point where, hey, this is just prohibitively expensive. Nevertheless, we still have lots of snowbirds, that are down in the United States. I have a conversation with my mother every Sunday, and I guarantee you the Canadian dollar comes up in every conversation like I can do something about it. And when you look at the winners and losers in the economy, what you find is that in aggregate, the benefits to the economy actually outweigh the negatives. And as a consequence, it's good for growth. But let me tell you, my mother is not, she isn't swayed by this, because at the end of the day, it's still costing her a lot of money to be abroad during the winter.
Where is she?
She's down in Florida.
She's in Florida. And when she asks you, why can't you do anything about this, what do you say to her?
Well, first of all, I explained to her that economists in the private sector don't have that much sway. Neither, as we already talked about, do policymakers. What we are seeing is a Canadian dollar responding to the weakness in the global economy. And I should stress that when we talk about the exchange rate, Canadians talk about the Canadian dollar. If you go to the United States and you say, what's, something about the exchange rate, they'll ask you which currency you're talking about, right? You're talking about the US dollar to the euro or the yen. In the case of Canada, we take it as given that when we say the value of the Canadian dollar, we mean the US dollar. And what we're seeing is actually the weakness in the Canadian dollar is a reflection of both remarkable strength in the US dollar. The weakness in the global economy is causing a lot of investors to move money into the United States. At the same time, the US Federal Reserve is talking about raising interest rates this year, and that makes the US dollar look attractive. So the US dollar is up against virtually all world currencies. It's very strong. It's really hurting their manufacturing sector. But at the same time, and that is part of the weakness in the Canadian dollar. And then the other part is the domestic side, which is the impact of commodity prices and the implications for Canadian economic growth.
If you're making movies in the United States and you want to come up here, you suddenly, you got a big payoff, didn't you?
Well, if you go back to when the Canadian dollar was below 70 cents in 2002, the film industry in Vancouver and Toronto was booming. When you turned on the television sets, you'd suddenly recognize the cities that they're being taped in, and all of a sudden Washington is Toronto. So the film industry in Canada benefits a lot. I think the tourist industry in Canada will benefit a lot, because the U.S. economy is creating a lot of jobs. Unemployment's quite low. We're now starting to see wages pick up in the United States, and at the same time, the U.S. dollar is really strong against the Canadian dollar. So that's another industry that will benefit.
Can we bring this chart up here? Because we understand that we're not doing well against the United States dollar right now. But how about the euro? This is the Canadian dollar value against the euro over the last 5 years. What do you see here that we need to know about?
Well, you can see that it's been fluctuating quite a lot. But if you were to actually stack the Canadian dollar versus the euro, you would actually, and the Canadian dollar against the US dollar, what you would see is the Canadian dollar has not lost nearly as much ground against the euro. It is weaker because Canada is, again, a commodity-based economy, and we are in a very big negative commodity price shock. So Canada is going to look less attractive than the euro. But when you think about what's going on in Europe, the European Central Bank is still injecting massive amounts of stimulus into their economy, and this is designed to actually keep the euro quite weak. And so on the Canadian dollar versus the euro, it hasn't lost nearly as much ground.
And against other currencies?
It's the story is the same, but with different nuances. So what you find is that, but in the case of Japan, the government is injecting massive stimulus to try and get the economy out of its long-term deflationary malaise. At the same time, in Europe, they're still dealing with the legacy of their fiscal crisis that erupted in 2010 and has only calmed down in recent years. And so you have a situation in Europe where interest rates are negative. Canada actually hasn't gotten to the point where short-term interest rates are negative, although the Bank of Canada said if things were bad enough, they would actually entertain the idea. But in the case of Europe, you have negative interest rates, which again makes the euro look very unattractive. So this is one of the reasons why the Canadian dollar has held up better against currencies like the euro and others. But at the end of the day, again, the value of the Canadian dollar is trading as if it's tied to oil. And what we're seeing in oil markets is there's a lot of concern about excess supply. Inventory levels are very high, and it's a product of the fact that China is slowing down, and so it's consuming less oil. But there's also a price war going on between OPEC, the big oil cartel in the Middle East, and non-OPEC nations. And what's happening is the oil cartel is trying to defend its market share. What they were seeing was the shale oil and gas revolution that unlocked a lot of supply in places like the United States meant that they were actually, the oil cartel was losing market share to these new producers. But the cost of production is cheaper in the Middle East. And so the price war has basically allowed prices to come down to levels that is going to impact the non-OPEC nations more. And so the question really is, how long does this go on? And I think what forecasters have gotten wrong is the willingness of OPEC to keep pumping oil at remarkably low levels. And the latest part of the latest news that pushed down oil prices has been not only the continuing weakness in China, but also uncertainty as to how much oil is going to be coming onto the market from Iran.
All right, speaking of the forecasters, we got a minute left here, and let's touch on this. David Doyle from Macquarie Capital Markets made a prediction the other day that he thinks the dollar, our dollar, could go down to 59 cents US. What do you think of that prediction?
There's an old financial market adage, and that is nobody wants to catch a falling knife. And what that says is that there's investors out there that are very negative, and then there are investors out there that are actually more glass half full. And the problem when the currency is tumbling, when oil prices are falling, is that the optimists actually get out of the way because they don't want to get hurt by the momentum downwards in the marketplace. But once oil stabilizes and once some of the worst fears are not realized, what tends to happen is the decline in oil will slow down, it'll stop, and when that occurs, some of the optimists will come in, and that's what triggers the bounce back in the currency. So if the Canadian dollar goes significantly downwards further for longer, ultimately it is going to reverse course because it's going to become deeply undervalued. And then the question is timing. And the one thing I'd stress is I don't honestly think strategists can predict with any degree of certainty the exact trough in the currency. When I hear a strategist say, the Canadian dollar could head down to 59 cents, the way I'd interpret that is that it's a signal to say, hey, I think the Canadian dollar is going to go lower. It isn't actually a signal that we're going to get exactly to 59 cents and then things will turn around. So I don't think you can predict the trough, and I don't think you can predict the timing.
Gotcha. Thanks for this, Craig.
Thanks, Steve.
Craig Alexander, C.D. Howe Institute.
Help TVO create a better world through the power of learning. Visit supporttvo.org and make a tax-deductible donation today.